Before we begin, a quick and important disclaimer. The information provided in this presentation is for educational and informational purposes only and should not be considered financial or investment advice. I am not a licensed financial advisor, and this video is not a substitute for professional financial guidance. Investing involves risk, including the potential loss of principal. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. You work hard. You clock in, you clock out, you do what it takes to earn a paycheck. And you try to be smart with it. You set up a 401k at your job, maybe you open an IRA. You check the box next to something called the Aggressive Growth Fund 2055, or the Balanced Portfolio, because it sounds right. Your money disappears from your paycheck and goes somewhere. You see the balance go up, sometimes down, but if you're being honest with yourself, you don't really know what you own. It feels like a black box, a financial mystery you're just supposed to trust. Well, you're not alone. Over 100 million Americans own mutual funds, making it the single most common investment for the average person. Yet, a huge portion of those people couldn't explain how they work, what they're paying for them, or why they own the specific ones they do. It's a multi-trillion-dollar industry built on a foundation of just trust us. Today we are going to shatter that black box. This isn't just another boring finance video. This is your roadmap to taking control. Over the next 10 parts, we are going to demystify the US mutual fund market from the ground up. By the end of this series, you won't just hope you're making the right decisions, you will know. You will understand the jargon, you will see the hidden fees, and you will have the confidence to build a portfolio that works for you, not just for the person selling it to you. So let's start with the absolute basics. What on earth is a mutual fund? Forget stocks, bonds, and confusing charts for a second. I want you to imagine a trip to the grocery store. You have $100 and you want to make a giant, healthy, well-balanced fruit salad. To do this, you need to buy a whole bunch of different things. Apples, oranges, bananas, grapes, kiwis, strawberries. Buying each one individually might be a hassle, and maybe you can't afford a whole case of each. Now imagine someone at the front of the store, a professional shopper, says, "Hey, a bunch of us are pooling our money together. Give me your $100 and I'll take our giant pile of cash. Go buy the best of every fruit in the entire store, and then give you your $100 share of the final massive fruit salad." That's it. In its simplest form, that is a mutual fund. It's a company that pools money from thousands, even millions of investors like you, and uses that giant pile of cash to buy a diversified collection of investments. The professional shopper is the fund manager. The giant collection of fruits, the apples, oranges, and bananas, are the individual stocks, bonds, and other assets. The big shopping cart holding everything is the portfolio. And your $100 share of that final fruit salad? Those are your shares in the mutual fund. Every day, the fund adds up the total value of all the fruits in the cart and divides it by the number of shares people own. This gives you the price for one share, a number called the net asset value, or NAV. So if the total fruit salad is worth $1 million and there are 100,000 shares out there, each share is worth $10. Simple as that. Now you might be thinking, okay, that's a nice story, but why not just go buy the fruit myself? Why not just buy Apple stock or Ford stock on my own? And that is the perfect question, because it gets to the very heart of why mutual funds were invented and why they became so incredibly popular. They solve three huge problems for the average investor. Problem number 1, diversification. Let's go back to the store. If you only have enough money to buy a big bag of apples, and it turns out those apples are rotten, well, you've lost all your money. Your entire investment is wiped out. This is the danger of putting all your eggs in one basket. But in the mutual fund's giant fruit salad, even if the apples are bad, you still have the oranges, bananas, grapes, and strawberries. The loss from the apples is cushioned by the performance of everything else. This is diversification. A mutual fund allows you, with a single purchase, to own tiny little pieces of hundreds or even thousands of different companies. If one of those companies goes bankrupt, it's a tiny dent in your portfolio, not a catastrophe. It's the ultimate safety in numbers. Problem number 2, professional management. Let's be real. Do you have the time to research hundreds of companies? To read their quarterly earnings reports, analyze their debt levels, study their competition, and decide if their stock is a good buy, a hold, or a sell? Probably not. You have a job, a family, a life. The fund manager, that professional shopper, this is their entire job. A team of analysts and experts works full-time, spending all day, every day doing that research for you. You are essentially outsourcing the hardest part of investing to a team of professionals. You're paying them to worry about the details so you don't have to. And problem number 3, the one that truly opened the doors of Wall Street to Main Street: accessibility and affordability. Let's say you want to own a piece of the biggest and best companies in America. As of right now, buying just one single share of Amazon might cost you a couple $100. One share of Google could be even more. To build a diversified portfolio of just 20 or 30 individual stocks on your own, you would need thousands, if not tens of thousands of dollars just to get started. It was a rich person's game. But with a mutual fund, you can invest as little as $50 or $100 and instantly own a sliver of Amazon, a sliver of Google, a sliver of Microsoft, and hundreds of other companies all at once. It breaks down the price barrier, giving you access to the same investments as the billionaires, but for the price of a nice dinner out. So let's recap. A mutual fund is a pool of money, managed by a professional, that buys a whole bunch of different investments to give you instant diversification and easy access to the market. It sounds perfect, right? It sounds like the ultimate cheat code for building wealth. And for millions of people it has been. But here's the catch, and it's a big one. Not all fruit salads are created equal. Some professional shoppers are brilliant and some are terrible. Some charge you a reasonable fee for their service, while others quietly skim so much off the top for themselves that they eat up all your potential profits. Some funds are designed to be safe and steady, while others are risky, high-stakes gambles. The beautiful simplicity on the surface hides a world of complexity underneath. A world of different strategies, styles, and most importantly, costs. And it's in those details that fortunes are made and lost. The difference between choosing the right fund and the wrong fund can be the difference between a comfortable retirement and working for an extra decade. This is where our journey truly begins. We've opened the black box and seen the basic machinery inside. Now we have to learn how to operate it. We need to understand the different types of funds, how to tell the good ones from the bad ones, and how to spot the hidden fees designed to drain your account. Because the goal isn't just to own a mutual fund. The goal is to own the right one for you. So, to find the right one, we first have to travel back in time. Not that far, just to the roaring 20s. Imagine it's 1924. The stock market is booming, stories of people getting rich are everywhere, and you want in. But there's a huge problem. Actually, there are 3 huge problems. First, you need a lot of money. A single share of a popular company could cost hundreds of dollars, which was a fortune back then. To build a proper portfolio of, say, 20 different stocks, you'd need the kind of cash that only the wealthiest people had. For the average person, it was like standing outside a fancy restaurant, smelling the food, but knowing you couldn't afford a single thing on the menu. Second, let's say you did have the money. What do you buy? There's no internet, no CNBC, no easy way to research companies. You'd have to pore over dense financial reports, understand complex industries, and basically make it your full-time job just to not lose your shirt. It was a game of knowledge, and the insiders had all the cheat codes. And third, it was incredibly risky. If you saved up and bought shares in just 1 or 2 companies, and one of them went bankrupt, which happened all the time, your entire investment, your life savings, could be wiped out in an instant. It was the ultimate high-wire act with no safety net. Investing was, for all intents and purposes, a club for the rich. An exclusive game played by people with money, time, and expertise that the average American simply didn't have. Then, in Boston, a few financial innovators had an idea. It was an idea so simple, yet so revolutionary it would fundamentally change the world of finance forever. They asked, what if we got a bunch of people to just pool their money together? Instead of one person trying to buy a bunch of stocks with their own limited cash, what if 100 people all put their money into one big pot? Suddenly, that pot is big enough to buy not just 1 or 2 stocks, but 50, or 100, or more. And every person who contributed to the pot would own a small piece of every single stock in that collection. That's it. That's the magic. That was the birth of the first modern mutual fund in the United States, the Massachusetts Investors Trust. It wasn't about a complex algorithm or a secret formula. It was about teamwork. It was about taking the power of the group and using it to open a door that had been locked for generations. This single idea solved all 3 of the major problems for the average investor in one elegant stroke. First, it solved the money problem. This is the principle of accessibility. You no longer needed a fortune to invest. With a mutual fund, your $50 combined with thousands of other people's $50 suddenly gave you a stake in massive, expensive companies you could never afford on your own. You got to own a tiny slice of the entire pie, instead of being unable to afford a single crumb. It democratized investing, turning it from a club for the wealthy into something accessible to anyone with a few dollars to spare. Second, it solved the knowledge and time problem. This is the principle of professional management. The people running this new kind of fund weren't just holding the money. Their job was to be the experts. They hired professional analysts and managers whose entire careers were dedicated to researching companies, analyzing markets, and making decisions about what to buy and sell. You, the investor, didn't have to spend your nights reading balance sheets. You were essentially hiring a team of Wall Street experts to do the heavy lifting for you. You were outsourcing the most difficult part of investing. And most importantly, it solved the risk problem. This is the crown jewel of the mutual fund: instant diversification. Diversification is just a fancy word for not putting all your eggs in one basket. If you own stock in one company and it fails, you lose everything. But if you own a mutual fund that holds stock in 200 different companies and one of them fails, it's a small dent, not a catastrophe. The success of the other 199 companies helps cushion the blow. The fund spreads your risk across a wide range of businesses, industries, and sometimes even countries. It's the ultimate financial safety net, built right into the product. So let's recap this core concept. A mutual fund is a company that pools money from many investors and invests that money in a diversified portfolio of stocks, bonds, or other assets. In return for your investment, you get shares of the fund itself, and you become a part owner of its entire collection of investments. Of course, this service isn't free. This is the fundamental trade-off. For the convenience of instant diversification and professional management, you pay a fee. These fees, which we will dissect in excruciating detail later in this series, are how the fund company makes its money. They pay the salaries of the managers, the researchers, and cover the costs of running the whole operation. And how these fees are structured is one of the most critical factors in determining a good fund from a bad one. Now, from that first simple idea in 1924, the mutual fund universe exploded into a dizzying array of options. But at their core, they all started from two basic structural designs: open-end funds and closed-end funds. Understanding the difference is like knowing the difference between a sedan and an SUV. They both get you down the road, but they're built differently. The vast majority of funds you'll ever encounter are open-end funds. The name open is the key. They are open to new money and open to withdrawals at any time. When you want to invest, the fund company creates brand new shares out of thin air and sells them to you. When you want to sell, the fund company buys your shares back from you and makes them disappear. Because of this, the size of the fund grows and shrinks every single day as money flows in and out. The price you pay for a share is calculated only once per day, after the market closes. This price is called the net asset value, or NAV. It's simply the total value of all the fund's investments, divided by the number of shares that exist. It's the true underlying value of your slice of the pie. The other, much less common type is the closed-end fund. The name closed is again the key. A closed-end fund is like a company that has an IPO. It raises money from investors once, issues a fixed number of shares, and then closes its doors to new cash. After that, those shares trade on a stock exchange just like shares of Apple or Ford. You don't buy them from the fund company. You buy them from another investor on the open market, through a broker. Because of this, their price isn't determined by the NAV. It's determined by supply and demand. This means a closed-end fund can trade for more than its assets are worth, called trading at a premium, or more often, for less than its assets are worth, trading at a discount. It's a whole different ballgame, and for a beginner, it's usually best to focus on the much simpler and more common open-end fund. So now we know what a mutual fund is at its core: a professionally managed, diversified, and accessible investment vehicle. We know it was born from a need to give the average person a fair shot. And we know the two basic structures it can take. But this is just the blueprint. It's the chassis of the car. We haven't even talked about the engine yet. The real question, the one that determines everything about the fund's performance, its risk, and whether it's right for you, is what is the fund actually investing in? Is it buying stocks from giant American companies? Is it lending money to the government by buying bonds? Is it investing in real estate? Or maybe a mix of everything? The contents of that portfolio, the strategy the manager uses to pick them, and the goals they are trying to achieve, that is what separates one fund from another. And that is where our journey gets really interesting. Think of the mutual fund universe not as a confusing mess, but as a massive, perfectly organized hardware store. You've just walked in wanting to build your financial future. And in this store there are aisles and aisles of different tools. Some are power saws designed for aggressive, fast cutting. Others are precision levels, designed for stability and keeping things steady. You wouldn't use a sledgehammer to hang a picture frame, and you wouldn't use a tiny screwdriver to break up concrete. The key isn't just knowing the tools exist. It's knowing what each tool is designed to do. At the highest level, almost every mutual fund in this store fits into one of two main categories. These are the two giant sections you see as soon as you walk in: the equity aisle and the fixed income aisle. Let's start in the equity aisle. Equity is just a fancy word for ownership. So, an equity fund, or as it's more commonly known, a stock fund, is a mutual fund that invests in stocks. It's a portfolio filled with tiny slices of ownership in public companies. When you buy a share of a stock fund, you are becoming a part owner of hundreds, sometimes thousands of different businesses all at once. This is the growth engine of your portfolio. This is the power saw. Stock funds are designed for long-term capital appreciation, which is the finance speak for making your money grow significantly over time. But even within this one aisle, there are many different types of power saws. The first way they're organized is by the size of the companies they invest in, what Wall Street calls market capitalization. First, you have the large cap funds. These are the titans, the household names, the Goliaths of the business world. Think Apple, Microsoft, Amazon, Johnson & Johnson. These are massive, established global corporations. Funds that focus on these large cap stocks are generally considered the most stable and least volatile within the stock market world. They're like a heavy-duty, reliable table saw. They might not grow at the explosive rate they once did, but they are powerful, proven, and form the foundation of many investment portfolios. Next, you have the mid-cap funds. These are the rising stars. Companies that are no longer small startups, but haven't yet reached the megacorporation status of a large cap. They're established but still have significant room to grow. They might be well-known brands in their specific industry, but maybe not a name your grandma recognizes. Mid-cap funds offer a blend, the potential for higher growth than large caps, but with more risk. They're like a versatile, powerful circular saw, more mobile and agile than the big table saw, with the potential to make quicker cuts. Finally, there are the small cap funds. These are the innovators, the disruptors, the scrappy underdogs. These companies are small, nimble, and have the potential for explosive growth. They could be the next big thing, or they could fizzle out. Investing in them is inherently riskier. For every future Amazon, there are thousands of companies that don't make it. A small cap fund is like a high-powered experimental cutting tool. It could be revolutionary and make the job go 10 times faster, or it could backfire. It offers the highest potential reward in the stock world, but it also comes with the highest potential for volatility. But company size is only one way to slice it. The other major way stock funds are categorized is by their investment style. This is the philosophy the fund manager uses to pick stocks. And the two dominant styles are growth and value. Growth investing is exactly what it sounds like. A growth fund manager is looking for companies that are expected to grow their earnings at a faster rate than the overall market. These are often tech companies, biotech firms, or any business in a rapidly expanding industry. They might not even be profitable yet. Think of a young Tesla. The stock price is high relative to its current earnings because investors are betting on its future potential. A growth fund is a bet on the future, on speed, on momentum. It's exciting, it's fast-paced, and it can lead to spectacular returns. But if that expected growth doesn't materialize, the fall can be just as spectacular. On the other side of the coin, you have value investing. A value fund manager is like a bargain hunter. They are searching for stocks that they believe the market has unfairly beaten down or overlooked. These might be solid, profitable, but boring companies in out-of-favor industries. Their stock price might be low compared to their assets or their earnings. The value investor's belief is that eventually, the market will realize its mistake, and the stock's price will rise to reflect its true worth. It's a more patient, methodical approach. It's less about betting on a sprinter and more about finding a marathon runner who got a slow start but has incredible stamina. So you can have a large-cap value fund, a small-cap growth fund, a mid-cap blend fund, and every combination in between. Each one is a different tool, designed for a slightly different job and risk tolerance. Now let's leave the noisy equity aisle and walk over to the other side of the store, the fixed income aisle. This is where you find the bond funds. If stock funds are the engine of your portfolio, bond funds are the shock absorbers and the brakes. They are designed not primarily for growth, but for stability and generating income. When you buy a bond, you're not buying ownership. You are lending money. You're acting as the bank. You lend your money to a government or a corporation, and in return they promise to pay you interest over a set period of time, and then return your original investment, the principal, at the end. That predictable stream of interest payments is why it's called fixed income. A bond fund is simply a mutual fund that holds a portfolio of hundreds or thousands of these different bonds. This diversification is crucial because if one single company defaults on its loan, it has a minimal impact on your overall investment. Just like with stocks, bond funds are categorized in a few key ways. The most important is who you're lending the money to, the issuer. First, you have government bond funds. These funds primarily invest in debt issued by the U.S. Treasury. Think Treasury bills, notes, and bonds. These are considered among the safest investments on planet Earth because they are backed by the full faith and credit of the United States government, which has the power to tax and print money to pay its debts. The trade-off for that safety? The interest payments are typically lower than other types of bonds. Then you have corporate bond funds. These funds lend money to companies. A corporation might issue bonds to build a new factory, fund research, or expand its operations. These are a step up in risk from government bonds. While a huge, stable company is very likely to pay you back, there's always a chance, however small, that it could go out of business. To compensate you for taking on that extra risk, corporations have to offer a higher interest rate than the government does. And within corporate bonds, there's a spectrum of risk called credit quality. Think of it like a borrower's credit score. Highly rated, financially sound companies issue investment-grade bonds. They're considered very safe, and thus pay a moderate interest rate. On the other end, you have lower-rated, riskier companies that issue high-yield bonds, which are politely called junk bonds. Because there's a higher chance these companies could default on their loans, they have to entice investors by offering much higher interest payments. So, you have your growth engines in the stock aisle and your stability anchors in the bond aisle. What if you want a bit of both? Well, there are also balanced funds or hybrid funds. These are the prepackaged kits. They invest in a mix of both stocks and bonds within a single fund, like a 60% stock, 40% bond allocation. They offer a simple all-in-one solution that provides both growth potential and a cushion of stability. Finally, there's one more special corner of the store. It's the cash register area, where you keep your wallet safe. This is where you find money market funds. These funds invest in very short-term, high-quality debt, like treasury bills and commercial paper. Their goal is not growth. It's preservation of capital and liquidity. They aim to keep their share price locked at $1. A money market fund is essentially a slightly higher-yielding alternative to a savings account. It's a safe place to park cash you might need soon, or a safe harbor during a volatile market. It's not a tool for building. It's a secure lockbox for holding. Large cap, small cap, growth, value, government bonds, corporate bonds, balanced funds, money markets. These are the fundamental building blocks. These are the tools in your workshop. And understanding what each one does is the first giant leap toward building a powerful financial future. But now we face the most important question of all. You see all these tools. You understand their purpose. But how are they actually put to use? Do you hire a master craftsman, a fund manager who spends every waking hour researching, hand-selecting each stock and bond, actively trying to beat the market? Or do you buy a simple, automated, all-in-one machine that doesn't try to be clever, but instead just aims to own the entire market for an incredibly low cost? This is the multi-trillion-dollar debate between active and passive management. And understanding the difference will change the way you think about investing forever. So, let's picture two very different approaches to grocery shopping. On one side, you have a world-famous celebrity chef. This chef is a genius. They claim they can go to the market and, using their incredible skill and intuition, pick out only the absolute best, most undervalued ingredients. They'll find the tomato everyone else overlooked, the cut of meat that's secretly the most tender. Their goal is to create a meal that is monumentally better than what anyone else could make. This chef is active management. On the other side, you have a different strategy. Instead of hiring an expensive chef, you simply decide to buy a tiny piece of every single item in the entire grocery store. You don't try to guess which vegetable will be tastiest or which brand of pasta is best. You just buy them all. You'll get the amazing tomatoes, but you'll also get the slightly bruised ones. You'll get the premium coffee and the generic brand. Your goal isn't to create a single perfect meal, but to own the economic output of the entire store. This is passive management. Now, on the surface, the celebrity chef sounds way more appealing, right? Who wouldn't want a genius working for them, trying to pick the winners and avoid the losers? This is the promise of an actively managed mutual fund. In an active fund, a portfolio manager or a whole team of them is making daily decisions. They're doing deep dive research into companies, analyzing balance sheets, meeting with CEOs, and tracking economic trends. They are actively buying stocks they believe are about to go up and selling stocks they think are about to go down. Their entire job, the reason they exist, is to use their expertise to beat the market's average performance. They are trying to deliver a return that's better than what you'd get if you just bought a little bit of everything. And for this service, this expertise, they charge a premium. Just like a celebrity chef, they're not cheap. This cost is bundled into something called the expense ratio, which we'll dive into deeper later. But for now, just think of it as an annual management fee. For active funds, this fee can be significant, often around 1%, sometimes even more. You're paying for their skill, their research, their team, and their time. You're paying them to win. Then there's the other approach, passive management. A passively managed fund, often called an index fund, has a much simpler, and some would say humbler goal. It doesn't have a celebrity chef. In fact, it barely has a cook at all. A passive fund doesn't try to beat the market. It is the market. Its one and only job is to replicate a specific market index. The most famous one is the S&P 500, which represents the 500 largest companies in the United States. A passive S&P 500 index fund will simply buy the stock of all 500 of those companies, in the exact same proportions as the index itself. If Apple makes up 7% of the S&P 500, the fund holds 7% of its money in Apple. If a new company enters the S&P 500, the fund buys it. If a company leaves, the fund sells it. There's no genius manager making brilliant predictions. There's no team of analysts trying to find hidden gems. It's almost entirely automated. It's a computer-driven strategy of just owning the market. And because there's no expensive celebrity chef to pay the cost, that expense ratio is incredibly, almost ridiculously low. We're talking fractions of a percent, sometimes as low as 0.03%. That's 100 times cheaper than some active funds. So here's the multi-trillion-dollar question. Who wins? The brilliant, expensive chef trying to pick the best ingredients, or the cheap, simple strategy of just buying the whole store? For decades, this was the central debate on Wall Street. And the answer, confirmed by mountains of data, is so counterintuitive it's hard to believe at first. The overwhelming evidence shows that the vast majority of celebrity chefs fail. Year after year, studies like the Spiva Report, which stands for S&P Indices versus Active, compare the performance of active fund managers against their passive benchmarks. And the results are brutal. In any given year, most active fund managers, these highly paid, brilliant experts, fail to beat the simple, boring, automated index fund. They don't even match the market's return, let alone beat it. And it gets worse. The longer the time period, the more devastating the results become. Over a 10 or 15-year period, the percentage of active managers who actually succeed in beating their index plummets. We're talking 80, 90, sometimes even 95% of active funds fail to outperform their passive counterparts. Think about what that means. It means if you pick 10 active funds at random, there's a very good chance that after a decade, 9 of them will have given you less money than if you had just bought the cheap, boring index fund and left it alone. How is this possible? How can the so-called smart money be so consistently wrong? It comes down to 3 massive hurdles that active managers have to overcome. The first hurdle is that the market is incredibly efficient. You have millions of the smartest, most competitive people in the world, all with powerful computers and access to the same information, all trying to do the same thing. Find an edge. The price of a stock at any given moment reflects the combined knowledge and analysis of all of them. For one manager to consistently know something that millions of others don't is almost impossible. It's not that they're not smart, it's that they are playing against an entire stadium full of geniuses. The second hurdle is the one we already mentioned, costs. This is the silent killer of returns. Let's use a simple example. Suppose the S&P 500 has a great year and returns 10%. The passive index fund, which just tracks it, also gets that 10% return. After its tiny fee of, say, 0.04%, your actual return is 9.96%. You basically got the market's performance. Now let's look at the active fund manager. To just tie with the passive fund, they also need to deliver a 9.96% return to their investors. But remember, they have a much higher fee, let's say a 1% expense ratio. This means their fund's investments don't just need to grow by 10%. They need to grow by almost 11% just for you to break even with the boring index fund. They start the race a full lap behind. They have to be not just as good as the market, they have to be significantly better year after year just to justify their own fees. It's like a high jump competition where the passive investor just has to step over a bar lying on the ground, while the active investor has to clear a bar that's set 3 feet high. And the third hurdle is human nature. Active managers are human. They're susceptible to the same emotions that trip up all investors: fear and greed. They can get caught up in hype and buy a stock at its peak, or panic during a downturn and sell at the bottom. They can feel pressure to take big risks to justify their fees, which can backfire spectacularly. A passive index fund has no emotion. It's a robot. It just follows its simple instructions. Own the market. It never panics. It never gets greedy. Just is. So, does this mean every single active fund is bad? No. There are a few managers, the true legends, who have beaten the market over long periods. But the problem is identifying them in advance. It's nearly impossible to tell which manager is truly skilled and which one just got lucky for a few years. Picking a winning active fund is, ironically, as hard as picking a winning stock. For the vast majority of people, the evidence is clear. The revolution in investing over the last 50 years has been the slow, dawning realization that accepting the market's average return through a low-cost, passive fund is a more reliable path to wealth than paying a premium for someone to try and beat the average. Simple, it's cheap, and most importantly, it works. So if this passive approach is so powerful, how do you actually do it? How do you buy hundreds of stocks with a single click, for a fee that's next to nothing? It all comes down to one of the most important inventions in modern finance: the index fund. And the story of its creation is a tale of rebellion, ridicule, and eventual triumph that changed Wall Street forever. The year is 1951. A young, fiercely ambitious Princeton student named John C. Bogle is hunched over a desk, finishing his senior thesis. The topic: the mutual fund industry. At the time, this industry was the undisputed king of Wall Street. It was a world of celebrity fund managers, brilliant stock pickers who were treated like financial wizards. They were the masters of the universe, using their supposed genius to navigate the chaotic seas of the stock market and deliver superior returns to their clients. For this wizardry, they charged hefty fees. And why not? They were the experts. They were worth it. But as Bogle crunched the numbers, a shocking, almost heretical idea began to form in his mind. He analyzed fund after fund, and the data was undeniable. A staggering number of these so-called experts weren't actually beating the market. In fact, after you subtracted their high fees, their management costs, and their trading commissions, the vast majority of them were actually underperforming the simple market average like the S&P 500. Investors were paying a fortune for a product that was delivering a subpar result. It was like paying for a five-star chef to cook you a gourmet meal, only to be served a cold hot dog and a bill for $200. Bogle's thesis landed on a revolutionary conclusion. Mutual funds, he wrote, can make no claim to superiority over the market averages. And then he posed the question that would shatter the foundations of the financial world. If the experts can't beat the market, and if trying to beat the market is incredibly expensive, why even try? Why not just buy the whole market? All of it. The good, the bad, the average. Why not create a fund that doesn't try to pick winners, but simply holds all the stocks in a market index like the S&P 500 and passively tracks its performance? By doing this, you would guarantee you'd capture the market's overall return. And because you're not paying for a team of high-priced analysts and constantly trading stocks, you could do it for an almost laughably low fee. To the Wall Street establishment, this was not just a bad idea. It was an insult. It was financial blasphemy. The idea of settling for average returns was considered un-American. The whole point of capitalism of Wall Street was to compete, to win, to be better than average. Bogle's idea was seen as a surrender, a white flag waved in the face of financial ambition. For the next 25 years, Bogle worked his way up inside that very industry, eventually becoming the head of Wellington Management Company. But that radical idea from his college thesis never left him. He saw the flaws of the system from the inside. He saw how the high fee structure incentivized managers to take big risks, not for their clients' benefit, but for their own. He saw how the pressure to beat the market every single quarter led to short-term thinking and poor long-term results. Then in 1974, after a contentious power struggle, he was fired. It was the lowest point of his career, but it was also the moment that set him free. Stripped of his high-powered job, he decided to build a new company from scratch. A company founded on that simple, powerful, and still ridiculed idea from his thesis. He named it Vanguard. Vanguard was different from the very beginning. Instead of being owned by outside stockholders, the company was owned by its own funds. This meant the company was effectively owned by the people investing in those funds. It was a radical structure designed to do one thing: put the investor first and drive costs down to the bone. And in 1976, Vanguard launched its flagship product, the first index investment trust. It was the world's first index fund available to the general public. It was Bogle's revolutionary idea made real, and Wall Street hated it. They mocked it relentlessly. It was nicknamed Bogle's Folly. A prominent poster from a competitor showed Uncle Sam pointing with the caption, "Help stamp out indexation. Index funds are un-American." They said no one would ever want to be just average. And at first it looked like the critics were right. The fund's initial public offering was a spectacular failure. The goal was to raise $150 million. They managed to scrape together just $11 million. It was a humiliating start. The fund was so small it couldn't even buy all 500 stocks in the S&P 500. It had to settle for the largest 200 and a sampling of the rest. But Bogle was patient. He believed in the math. He called his core philosophy the cost matters hypothesis, and it was brutally simple. Your net return as an investor is simply the gross return of the market minus the costs you pay. The less you give away in fees, the more you keep for yourself. It's an undeniable, iron law of arithmetic. While Wall Street was selling a story about genius and magic, Bogle was selling a story about math and common sense. Think of it like two runners in a marathon. One is the stock market itself. The other is an actively managed fund trying to beat it. The fund manager might be a fantastic runner, maybe even faster than the market for short sprints. But he's running the entire race with a heavy backpack full of fees, taxes, and trading costs. The market is running with no backpack at all. Over the course of 26.2 miles, who do you think is going to win? The math is relentless. The backpack always wins. The index fund strategy is simple. Instead of trying to outrun the market with a heavy backpack, just hop on the market's back and enjoy the ride. You won't beat it, but you won't lag behind it either. You get its full power, its full return minus a tiny featherlight cost. For years, Bogle's Folly was a niche product, a curiosity for academic types and penny pinchers. But slowly, painstakingly, the evidence began to pile up. Year after year, the S&P 500 index, and by extension Bogle's fund, would outperform the majority of the high-fee, actively managed funds. The data from his college thesis was playing out in real time with real money. Then investors started to notice. They began to realize they were paying for that gourmet meal and getting the cold hot dog. They started moving their money, a trickle at first, then a stream, then a flood, out of expensive underperforming funds and into Bogle's simple low-cost alternative. Today, the revolution Bogle started is complete. Index funds are no longer a folly. They are the bedrock of modern investing. That initial $11 million fund, now called the Vanguard 500 Index Fund, holds over $1 trillion in assets. The company he founded, Vanguard, manages over $8 trillion. The simple idea from a college kid's thesis has saved everyday investors, people like you and me, literally trillions of dollars in fees that would have otherwise gone into the pockets of Wall Street. It is arguably the greatest financial innovation for the individual investor in history. Jack Bogle proved that in investing you don't get what you pay for. In fact, you get what you don't pay for. He changed the game not by being a better stock picker, but by changing the rules of the game itself. He took power from the financial elite and gave it back to the individual. So now we understand the what and the why. We know an index fund is a basket of stocks that mirrors a market index, and it was born from a rebellion against the high-cost, underperforming status quo. But knowing the history is only the first step. The S&P 500 isn't the only game in town. There are index funds that track thousands of different markets, from small U.S. companies to international stocks to the entire global bond market. So how do you navigate this universe that Bogle created? How do you choose the right index for your goals? And what's the difference between an index mutual fund and its increasingly popular cousin, the ETF? Well, let's start with the first and biggest question. How do you choose the right index? Think of this like choosing the foundation for your house. Everything else gets built on top of this decision. While there are thousands of indexes out there tracking every imaginable niche, from cybersecurity companies to businesses focused on pet care, a beginner should ignore all of that noise. For 99% of people, the journey begins with just a few foundational, incredibly broad indexes. The most famous of them all is the S&P 500. You hear about it on the news every single night. The S&P 500 is simply an index that tracks the 500 largest and most influential publicly traded companies in the United States. When you buy an S&P 500 index fund, You are buying a tiny microscopic sliver of Apple, Microsoft, Amazon, Google, Johnson & Johnson, and 495 of their closest friends. It's a powerhouse portfolio of American capitalism. For decades, it's been the default go-to investment for millions. And for good reason. It's diversified across all major sectors of the U.S. economy and has a phenomenal long-term track record. But what if you could do even better? What if you could be even more diversified? See, the S&P 500, for all its glory, only represents about 80% of the U.S. stock market's value. What about the other 20%? What about the thousands of medium-sized and small-sized companies, the potential next Apples and next Amazons that are still growing? This is where a total stock market index comes in. Instead of just owning the 500 biggest companies, a total market index fund aims to own all of them. We're talking over 3,500 U.S. stocks, large, medium, and small. If the S&P 500 is like owning a slice of every team in the NFL, the total stock market index is like owning a slice of every team in the NFL, the NCAA, and every high school team in the country. It is the ultimate in U.S. stock market diversification. John Bogle himself, the man who invented the index fund, eventually came to believe that the total stock market index was superior to the S&P 500 for this very reason. You capture the entire market, not just the biggest players. But wait. Both of these indexes, the S&P 500 and the total U.S. stock market, share a potential weakness. They are 100% focused on the United States. Investing only in your home country is a phenomenon called home country bias, and it can be risky. The U.S. has had an incredible run for the past century, but history teaches us that no single country stays on top forever. What if the next 30 years of explosive growth doesn't come from Silicon Valley, but from Seoul or Stockholm or Sao Paulo? To protect against this, wise investors look globally. This brings us to our third foundational index, the Total International Stock Market Index. This type of fund buys you a piece of thousands of companies outside the United States. We're talking about giants like Toyota in Japan, Samsung in South Korea, Nestle in Switzerland, and LVMH in France, plus thousands of other companies across developed and emerging markets. By combining a U.S. index fund with an international index fund, you are truly diversified across the entire global economy. You no longer care which country does best. You're positioned to benefit from growth wherever it happens on Earth. So far, we've only talked about stocks. But stocks, as we know, can be volatile. They're the engine of your portfolio designed for growth. But every engine needs a good set of brakes and a solid suspension system. That's where bonds come in. This leads us to our final foundational index, the Total Bond Market Index. A total bond market fund invests in thousands of different high-quality U.S. bonds, primarily U.S. government securities and investment-grade corporate bonds. Its job isn't to produce spectacular growth. Its job is to provide stability and income, to be the anchor that zigs when your stocks zag. When the stock market panics and falls 20%, a bond fund tends to hold its value or even go up slightly, providing a crucial cushion for your portfolio and your peace of mind. So those are the four pillars: S&P 500 or total U.S. stock, total international stock, and total U.S. bond. These are the simple, powerful building blocks for a lifetime of successful investing. Now, this brings us to that second critical question. You've decided you want to buy, say, a total U.S. stock market index. You go to a brokerage website and you're immediately faced with a confusing choice. You see a total stock market index mutual fund, and you also see a total stock market ETF. They seem to own the exact same stocks, but they have different ticker symbols and are presented as different things. So what's the deal? What is the difference between an index mutual fund and its popular cousin, the ETF? Think of it like this: the index itself, the collection of stocks, is the soda. The mutual fund and the ETF are just two different ways to drink it. One is a fountain drink you get from the counter, and the other is a can you grab from the cooler. It's the same Coke inside, but the delivery mechanism is different. Let's break down those differences. The single biggest difference comes down to how they are traded. A traditional mutual fund only buys and sells once per day, after the market closes at 4 p.m. Eastern Time. The price you get is called the net asset value, or NAV, which is the total value of all the fund's holdings at the end of the day, divided by the number of shares. This means if you place an order to buy a mutual fund at 10 a.m., your order just sits there all day. You have no idea what the final price will be until after the market closes. An ETF, which stands for Exchange Traded Fund, works completely differently. As the name implies, it trades on a stock exchange just like a share of Apple or Ford. Its price fluctuates all day long, from the opening bell to the closing bell. You can buy or sell it at 10 a.m., 1 p.m., or 3:59 p.m., and you'll get the price at that exact moment. This real-time pricing and trading is the hallmark of an ETF. The second key difference is the minimum investment. Historically, mutual funds have required a minimum initial investment to get started. This might be $1,000 or often $3,000. For a beginner just starting out, that can feel like a huge hurdle. ETFs, on the other hand, have no investment minimum. The minimum is simply the price of one share. If an ETF share costs $150, you can start with $150. And today, with the rise of fractional shares at most brokerages, you can often start with as little as $1. This accessibility has made ETFs incredibly popular with new investors. The third difference is more about psychology and automation. Mutual funds are the undisputed champions of automated investing. It is incredibly easy to set up a plan to automatically transfer, say $200 from your checking account every 2 weeks to buy more of your mutual fund. This set it and forget it approach is the gold standard for building wealth consistently over time. It takes emotion and timing out of the equation. While some brokerages are getting better at automating ETF purchases, it's traditionally been a more manual process. More importantly, the very nature of an ETF can tempt you into bad behavior. Because you can see the price bouncing around all day, you might be tempted to trade it. You might see the market dip at 11 a.m. and think, I should sell now before it gets worse. Or you might try to time your purchase to the exact low point of the day. This is a loser's game. The greatest strength of an ETF, its constant tradability, can be the greatest danger to a long-term investor's discipline. Finally, there's a slightly more complex difference that matters in one specific situation: taxes. This only applies if you are investing in a regular, taxable brokerage account. It does not matter in a retirement account like a 401k or an IRA. Due to some complicated back-end financial plumbing, ETFs are generally more tax efficient than mutual funds. Mutual funds sometimes have to sell stocks to pay back investors who are cashing out, and this can create capital gains that get passed on to all the fund's shareholders, even those who didn't sell. This means you could get a tax bill at the end of the year just for holding the fund. ETFs have a unique creation and redemption process that cleverly avoids this problem most of the time. The bottom line is, in a taxable account, ETFs often have a slight tax advantage. So, who wins the showdown? The classic mutual fund or the modern ETF? The honest answer is, for most people, it doesn't really matter that much. Both are fantastic, low-cost vehicles for owning an index. The choice comes down to your personal preference. If you value the ability to automate your investments with military precision, and you want to remove any temptation to tinker, the traditional index mutual fund is your steadfast, reliable partner. If you're starting with a smaller amount of money, or you're investing in a taxable account and want that extra tax efficiency, the ETF is an outstanding choice. Don't get paralyzed by this decision. Choosing between a Vanguard Total Stock Market mutual fund and a Vanguard Total Stock Market ETF is like agonizing over whether to get that Coke as a fountain drink or in a can. The important thing is that you've decided to drink the Coke, that you've decided to invest in the broad market index in the first place. That's 99% of the battle. Choosing your index and choosing your wrapper mutual fund or ETF is step one. But how do you combine them? How much should you put in US stocks versus international stocks? How much in bonds? Getting this mix right, your asset allocation, is the single most important decision you will ever make as an investor. It has a bigger impact on your long-term returns than almost anything else. And that is exactly what we're going to build step by step in the next part. So where do we begin? How do we take this abstract idea of asset allocation and turn it into a real-world, tangible investment portfolio? It can feel overwhelming, like being handed a 1,000-page instruction manual with no pictures. But I'm going to let you in on a secret. The most effective strategies are often the simplest. We're not going to build a portfolio with 20 different confusing ingredients. We're going to build a powerful, resilient, and world-class portfolio using just 3. Think of it like building a championship sports team. You don't need a roster of 50 mediocre players. You need 3 core superstar components that work together perfectly: a powerful offense, a global reach, and an unbreakable defense. This framework is famously known as the 3-fund portfolio, and it is, without a doubt, the single best starting point for nearly every new investor. Let's meet our first player. The offense. This is the heart of your team, your star quarterback, the engine that drives you down the field and scores the points. In the investing world, this is a U.S. Total Stock Market Index Fund. This one fund is your ticket to owning a piece of the entire American economy. When you buy a share of this fund, you're not just betting on one company like Apple or Amazon. You are simultaneously buying a tiny slice of Apple, Amazon, Microsoft, Google, Tesla, Walmart, Johnson & Johnson, and thousands, literally thousands of other US companies big and small. It's the ultimate diversification within a single country. If one company has a bad year, another might have a great one. If one sector struggles, another might soar. Over the long term, the US stock market has been one of the most powerful wealth creation machines in human history. This fund is your core engine for growth. It's designed to capture that broad market return, providing the primary horsepower for your portfolio for decades to come. This will be the largest part of your portfolio, your primary offensive weapon. But no smart coach relies on just one superstar. What if your star player has an off decade? It happens. For a long time, international markets actually outperformed the US market. A wise team owner knows you need to scout for talent globally. This brings us to our second player, the global reach. This is your international total stock market index fund. It does for the rest of the world what the first fund does for the United States. It gives you ownership in thousands of leading companies across developed and emerging markets. Think of companies like Toyota in Japan, Samsung in South Korea, Nestle in Switzerland, or LVMH in France. This isn't just about adding more companies. It's about adding a crucial layer of diversification. The US economy, while massive, is still only a fraction of the global economy. Economic cycles are different around the world. Sometimes the US will lead and other times Europe or Asia will. By owning an international fund, you ensure that you're not tying your entire financial future to the fortunes of a single country. You're insulated from home country bias, the dangerous belief that your own country's market will always be the best. This player ensures your team is competing and winning on a global stage, no matter which region is currently thriving. So now we have a powerhouse offense with both domestic and international stars. We're set up for growth. But as any legendary coach will tell you, offense wins games, but defense wins championships. What happens when the market goes through a brutal, bone-crushing downturn? What happens when a recession hits and stock prices are falling? You need a part of your team that holds the line, that protects your capital, that provides stability when everything else is in chaos. This is our third and final player, the unbreakable defense. This is your U.S. Total Bond Market Index Fund. Bonds are the unsung heroes of a portfolio. They're not as flashy as stocks. They don't typically produce those spectacular double-digit returns. But that's not their job. Their job is to be the shock absorber. Bonds are essentially loans you make to corporations or the government, for which they pay you interest. They are generally much safer and less volatile than stocks. When the stock market panics and plunges, investors often flock to the safety of bonds, which can cause bond prices to hold steady or even rise. This creates a beautiful balancing effect in your portfolio. When your offense is getting hammered, your defense is on the field, preventing a total catastrophe. This fund provides stability, reduces the overall volatility of your portfolio, and makes it psychologically easier to stay invested during scary times instead of panic selling at the bottom. It's the bedrock of your financial security. So there they are, our three champions: the U.S. Stock Fund for domestic growth, the International Stock Fund for global reach, and the U.S. Bond Fund for stability and defense. Now for the multi-million-dollar question. We have the players, but how much playing time does each one get? What percentage of our money goes into each fund? This, my friends, is the art and science of asset allocation. And again, we're going to keep it simple and effective. A great starting point for determining your stock and bond split is a simple rule of thumb. 110 minus your age. Take the number 110, subtract your current age, and that's the percentage of your portfolio that should be in stocks. The remainder goes into bonds. Let's walk through an example. Say you are 30 years old. 110 minus 30 equals 80. So you would aim to have 80% of your portfolio in stocks and the remaining 20% in bonds. Why does this work? Because when you're young, you have a long time horizon. You have decades to recover from any market downturns, so you can afford to take on more risk for a higher potential reward. Your portfolio should be heavily weighted towards your growth engines, your stock funds. As you get older, say you're 60 years old, the formula changes. 110 minus 60 equals 50. Now, you would have 50% in stocks and 50% in bonds. As you approach retirement, your priority shifts from aggressive growth to capital preservation. You have less time to recover from a market crash, So you want your defense, your bond fund, to play a much larger role, protecting the wealth you've already built. This simple formula automatically adjusts your risk level throughout your life. Okay, so for our 30-year-old, we have an 80-20 split. 80% stocks, 20% bonds. But how do we split that 80% stock portion between our US fund and our international fund? A common and sensible approach is to put about 70% to 80% of your stock money in the US fund, and the remaining 20% to 30% in the international fund. Let's use an 80-20 split for this example to keep it simple. So, we take that 80% allocated to stocks and we put 80% of it into the US fund. That's 80% times 80%, which equals 64%. The other 20% of our stock money goes to the international fund. That's 20% times 80%, which equals 16%. And there it is. We've done it. For a 30-year-old investor, a fantastic, diversified, low-cost starting portfolio is 64% in a U.S. total stock market index fund, 16% in an international total stock market index fund, and 20% in a U.S. total bond market index fund. That's it. That's the blueprint. It's not some complex secret held by Wall Street gurus. It's a simple, elegant, and profoundly effective strategy that has been championed by legendary investors like John Bogle, the founder of Vanguard. It gives you broad diversification across thousands of companies and bonds, both in the US and abroad, all within just 3 simple low-cost mutual funds. You now have the exact architectural blueprint for your financial future. You know the what and the why. You understand the components and the logic behind their proportions. But there's one crucial piece missing: the how. How do you actually find these specific funds? What are their names? Their ticker symbols? And where do you even go to buy them? Which brokerage should you use? That is the mission for our next part. We're moving from theory to action, from the blueprint to the hardware store, to give you the exact tools you need to finally start building. Alright, you're standing in the middle of a massive hardware store. The aisles stretch on forever, gleaming with every tool imaginable. There are power drills, laser levels, and complex contraptions you don't even recognize. All you want to do is hang a single picture frame, but the sheer number of options is paralyzing. This is exactly what it feels like when you decide you're ready to invest and ask the question: where do I actually buy a mutual fund? You Google best brokerage firm, and are hit with a tidal wave of names: Fidelity, Vanguard, Charles Schwab, E-Trade, Robinhood, M1 Finance, Webull. The list goes on. Each one claims to be the best, the cheapest, the easiest. It's overwhelming. And this is the exact point where so many people just give up. They close the browser tab and say, "I'll figure this out later." But you're not going to do that, because I'm going to let you in on a secret. To hang that picture frame, you don't need the most expensive 100-piece professional toolkit. You just need one good, reliable screwdriver. And to start investing in mutual funds, you don't need the most complex platform with a million features. You just need a safe, reputable, and low-cost place to build your wealth. So let's cut through the noise. For a beginner focused on long-term investing in mutual funds, the universe of choices really boils down to 3 titans. 3 household names that have stood the test of time and are, for all intents and purposes, the gold standard. They are Fidelity, Vanguard, and Charles Schwab. Honestly, the differences between these 3 are like the differences between a Toyota, a Honda, and a Subaru. They are all fantastic, reliable, and will get you safely to your destination. Choosing any one of them is 1,000 times better than staying parked in the driveway. But they each have a slightly different philosophy, a different origin story, that might make one a better fit for you. Let's start with Vanguard. If the mutual fund world has a revolutionary folk hero, it's Vanguard's founder, John C. Bogle. Back in the day, the investment industry was charging people outrageously high fees that were eating away at their returns. Bogle looked at this and said, "This is wrong." He believed the firm managing your money should work for you, the investor, not for outside corporate owners. So he created Vanguard with a radical new structure. Vanguard isn't owned by public shareholders. It's owned by its own funds. And those funds are owned by you, the investor. Think about what that means. There are no Wall Street owners demanding a cut of the profits. All the profits are returned to the investors in the form of lower fees. This isn't a marketing gimmick. It's built into their DNA. Vanguard is the purest choice. They pioneered the low-cost index fund. Their mission is singular: to keep your costs as low as humanly possible so more of your money stays in your pocket, compounding for your future. The trade-off? Their website and app have historically been a bit more no-frills. It's functional, powerful, but maybe not as sleek or flashy as some of the newer players. Choosing Vanguard is a statement. It's for the investor who values mission and the lowest possible cost above all else. Next up is Fidelity. If Vanguard is the principled revolutionary, Fidelity is the savvy innovator and the king of customer experience. Fidelity is a privately owned powerhouse that competes by constantly trying to one-up the competition with better technology and more features. Their website and mobile app are consistently ranked as the best in the business. They are clean, intuitive, and incredibly easy to use. They were the first to launch zero expense ratio index funds. That's right, funds that cost you literally nothing to own. It was a shot across the bow to the entire industry. Fidelity is like a giant financial supermarket. You can find everything under one roof: fantastic mutual funds, great research tools, checking accounts, credit cards, retirement planning services. Their customer service is legendary. If you call them, a real, knowledgeable human being picks up the phone, often on the first or second ring. For a beginner who feels a little intimidated and wants the best user experience and a helping hand, Fidelity is incredibly hard to beat. They make the process of investing feel accessible and even easy. Finally, there's Charles Schwab. Schwab is the wise, respected elder statesman that blends the best of both worlds. Like Vanguard, they are a fierce advocate for the individual investor and have a long history of driving down costs. Chuck Schwab himself basically invented the discount brokerage, slashing the exorbitant commissions that brokers used to charge just to buy a stock. But like Fidelity, they also pour immense resources into technology and customer service. Schwab offers a fantastic, well-rounded experience. Their platform is robust, packed with high-quality research and educational tools that can help you grow as an investor. They offer a massive selection of their own low-cost mutual funds and ETFs, plus access to thousands of others. Schwab often appeals to the investor who wants a bit of everything. Low costs, great service, and powerful tools, all from a brand that has been a trusted pillar of the financial world for decades. So which one do you choose? Vanguard, Fidelity, or Schwab? Let me make it simple. If you are driven by the core principle of keeping costs at rock bottom, and you align with the investor-first mission, go with Vanguard. If your top priority is a seamless, easy-to-use website and app, zero-cost fund options, and fantastic customer support, go with Fidelity. If you want a great all-arounder with a stellar reputation and a treasure trove of research tools to help you learn, go with Charles Schwab. But here is the most important part. Do not spend more than 1 hour making this decision. The difference in your long-term outcome between picking one over the other is minuscule compared to the massive cost of not starting at all. Pick the one that resonates with you and let's move on to the next step. Because choosing the brokerage is just picking the car. Now we need to actually open the door and get inside. Opening an account is surprisingly simple and takes about 15 minutes. It's less complicated than signing up for a new social media account. Here's the playbook. First, you'll go to the website of your chosen firm, fidelity.com, vanguard.com, or schwab.com. You'll see a big button that says, Open an account. Click it. Second, you'll be asked what type of account you want to open. This is a key step. For most beginners, there are two main choices: a standard brokerage account, often called an individual account, or a retirement account like a Roth IRA. Think of the standard brokerage account as your flexible, do-anything investment account. You can put money in and take it out whenever you want, though you'll pay taxes on your investment gains. A Roth IRA, on the other hand, is a superpowered retirement account. You contribute money that you've already paid taxes on, but then it grows completely 100% tax-free. When you pull it out in retirement, you owe nothing to the IRS. It's one of the best deals available to investors. If you don't have a retirement account yet, starting with a Roth IRA is an absolutely brilliant move. You can contribute up to a certain limit each year set by the government. If you want more flexibility or you've already maxed out your IRA, then open a standard brokerage account. You can, and many people do, have both. Third, you'll fill out your personal information. This is standard stuff: your name, address, date of birth, and your social security number. They need this for tax purposes and to verify your identity. This is a highly regulated industry, and these firms have fortress-like security. Fourth and finally, you'll need to fund the account. This usually means linking your regular checking or savings account from your bank. You'll provide your bank's routing number and your account number. Just like setting up any other online payment, you can start with any amount you're comfortable with, whether it's $50 or $5,000. And that's it. You've done it. You've gone from a passive observer to an active participant. You now have an account with one of the most respected financial institutions in the world, ready and waiting for your instructions. You have the key to the machine. You've built the foundation. The money is in the account. The engine is humming, waiting for you to press the accelerator. Now comes the most important moment of all. The decision that turns all this theory into reality. You have to actually choose and buy your very first mutual fund. Which one will it be? An S&P 500 index fund? A total stock market fund? Something else entirely? This final critical choice is where we go next. We're about to put your money to work. And so you stand at the edge of the diving board. You've learned the theory of swimming, you understand the properties of water. You've even picked out your swimsuit. But now you have to jump. This is the moment where knowledge has to become action. It's exciting, but for many, it's also terrifying. The sheer number of choices can feel paralyzing. There are over 7,000 mutual funds in the United States. 7,000. How in the world are you supposed to pick the right one? It feels like trying to find one specific grain of sand on a vast beach. But here is the secret that simplifies everything. For your very first investment, for the foundation of your entire financial future, you don't need to worry about 99.9% of those funds. The noise, the complexity, the jargon, you can ignore it. We're going to narrow down that universe of 7,000 choices to just 2. And by the end of this, you'll be able to choose between them with unshakable confidence. Your first decision isn't about a specific fund, it's about a strategy. You need to decide if your first fund will be the bedrock core of your portfolio, or a smaller, more specialized satellite. A satellite investment might be a fund that focuses only on technology, or healthcare, or emerging international markets. These can be great, but they are not the place to start. Starting with a specialized fund is like building the chimney before you've laid the foundation of your house. It makes no sense. Your first fund, the one that will receive your first dollar, must be a core investment. The absolute center of your financial world. A core fund is 3 things. It is incredibly diversified, it is dirt cheap, and it is designed to be held for decades. Its job isn't to hit a home run on one specific stock. Its job is to own the entire field, the stadium, and the parking lot. Its job is to capture the growth of the entire market over time. This brings us to our second decision, and it's one we've touched on before, but now it becomes a real practical choice. Active versus index. Remember the debate? The star manager who tries to beat the market versus the simple fund that just tries to be the market. For your core foundational investment, the evidence is overwhelming. You want an index fund. Think of it this way. An actively managed fund is like a high-performance Formula One race car. It's incredibly complex, requires a team of expensive experts to run it, and it promises breathtaking speed. An index fund is like a Toyota Camry. It's not flashy. It's built with simple, reliable parts. It's designed to run for 300,000 miles with nothing more than basic maintenance. And it just works. Now, the Formula One car might win a race on a Sunday, but over the course of a 30-year road trip across the country, which car are you betting on to get you to your destination with the least amount of drama and the lowest cost? It's the Camry every single time. The high fees and complexity of the active fund act like a constant mechanical drag, while the index fund just quietly and efficiently compounds your money, year after year. So decision 2 is made. We're looking for a core, low-cost index fund. See how quickly we're clearing away the noise? We've gone from 7,000 funds down to a much smaller, more manageable group. And within that group, for beginners in the United States, the conversation almost always comes down to a final showdown between 2 heavyweight champions. In one corner, you have the most famous index in the world, the S&P 500 Index Fund. And in the other corner, you have its bigger, more comprehensive cousin, the Total U.S. Stock Market Index Fund. This is it. The final choice. Let's break them down. An S&P 500 index fund buys you a tiny slice of the 500 largest, most influential companies in America. Think Apple, Microsoft, Amazon, Google, Johnson & Johnson. These are the titans of the industry, the household names. When you hear a news anchor say the market was up today, they are almost always talking about the S&P 500. It is the benchmark, the gold standard for the health of the U.S. economy. Investing in an S&P 500 fund is a powerful, concentrated bet on the continued success of America's biggest and best companies. Now let's look at the other contender. A total stock market index fund does something slightly different. It buys the entire S&P 500, and then it keeps going. It also buys thousands of other publicly traded companies in the U.S. It buys the mid-sized companies, the ones that might be the titans of tomorrow, and the small-sized companies, the scrappy innovators just getting started. If the S&P 500 is owning the all-star team, the total stock market fund is owning the entire league. It is the ultimate expression of diversification within the US. You're not just betting on the current winners. You're betting on the entire American enterprise, big and small. So which one is better? The arguments for each are compelling. Supporters of the S&P 500 will say, why bother with the small fish? The 500 largest companies make up over 80% of the entire market's value anyway. Stick with the proven winners. Supporters of the total stock market will counter. Why try to pick winners at all? By owning everything, you guarantee you'll own the next Amazon or the next Google before it becomes a household name. It's true diversification. This is the point where many beginners get stuck in analysis paralysis, spending weeks or months agonizing over this decision. So let me give you the single most important piece of data in this entire series. If you plot the performance of an S&P 500 index fund and a total stock market index fund on a graph over the last 30 years, they are nearly identical. The lines on the chart are so close they almost look like one. Some years the S&P 500 does slightly better. Other years, the total market has a slight edge because its smaller companies had a good run. But over the long haul, their performance is astonishingly similar. We're talking about a difference that is, for all practical purposes, a rounding error. So what is the right answer? Which one should you choose? The right answer is, it doesn't matter. Let me say that again. For a beginner starting their journey, the difference between these two funds is so small, it is not worth a single minute of your stress. Choosing between an S&P 500 fund and a total stock market fund is like agonizing over whether to start a marathon with your left foot or your right foot. The important thing is not how you start the first step, but that you actually start running. The single biggest mistake you can make is letting the fear of making a suboptimal choice prevent you from making a good choice. Both of these are fantastic A+ choices. Pick the one whose story resonates more with you. Do you want to bet on the titans of industry? Go with the S&P 500. Do you like the idea of owning a piece of the entire American economy? Go with the total stock market. Flip a coin. You literally cannot make a bad decision here. So you've made your choice. Let's say you've picked the total stock market index fund. Now what? You go into your brokerage account, your Vanguard, your Fidelity, your Schwab, and you need to find that fund. Every fund has a unique, 5-letter ticker symbol. For example, Vanguard's total stock market index fund is VTSAX. Fidelity's is FSKX. For the S&P 500, you might see tickers like VFIAX or FXAIX. You simply type that ticker symbol into the search bar of your brokerage account. The fund will pop up. You'll see a big green button that says Buy. You'll decide how much money you want to invest, you'll confirm the trade, and you will click that button. And just like that, you've done it. You are no longer just a saver. You are an owner. You are a shareholder in the largest and most innovative companies in the world. That money you earned is no longer sitting idle. It is now out in the world working for you 24 hours a day, 7 days a week, even while you sleep. Take a moment to appreciate what you've just accomplished. You have taken the single most important step toward building a secure financial future. But buying that first share is not the finish line. In fact, it's just the starting gun. Because owning the fund is easy. The real challenge, the part that separates those who build modest savings from those who build life-changing wealth, is what you do next. It's what you do tomorrow, next month, next year, and 10 years from now when the market inevitably crashes. The secret isn't in picking the perfect fund. The secret is in the system you build around it. And mastering that system, that is the final piece of the puzzle. So what is this system? Is it a complex algorithm? A secret trading strategy whispered in the backrooms of Wall Street? No, something far more powerful and thankfully far simpler. The system isn't in the market, the system is you. It's a framework for your own behavior. It consists of 3 pillars, and if you build them correctly, they will support your financial goals through any storm the market throws at you for the rest of your life. The first pillar is the automation engine. This is the mechanical heart of your entire strategy. Human beings are flawed. We forget. We get busy. We get scared. We make excuses. The single greatest point of failure in any long-term plan is the need for repeated, manual action. The automation engine removes that failure point entirely. You are going to build a machine that invests for you without emotion, without hesitation, on a schedule you dictate. Here's how it works. You choose your fund, that simple low-cost index fund we've talked so much about. You choose an amount you can comfortably invest on a regular basis. It could be $50, it could be $500. The amount is less important than the consistency. Then, you go into your brokerage account and set up an automatic transfer and investment from your bank account. You set it for the same day every single month or every 2 weeks, ideally the day after you get paid. You do this once. It might take you 10 minutes. And for those 10 minutes of work, you have constructed a wealth-building machine that will now work for you tirelessly in the background of your life for the next 40 years. Every single month, like clockwork, it will pull that money and buy more shares of your chosen fund. When the market is up, your money will buy fewer shares. When the market is down, when the news is screaming about a recession and everyone is panicking, your machine, your beautiful, unfeeling, logical machine, will calmly take that same amount of money and buy more shares at a discount. You are turning volatility, the very thing that terrifies most investors, into your greatest advantage. You are systematically buying more of an asset when it's on sale. This isn't market timing. It's the exact opposite. It is time in the market guaranteed. Building this engine is the single most effective action you can take to ensure your success. The second pillar is the emotional fortress. This is where the real war is won. Your automation engine will handle the mechanics, but you still have to handle the man in the mirror. The market is a master at playing on our two most primal emotions, fear and greed. When prices are soaring, you'll feel the greed, the FOMO, the urge to throw more money in, to chase hot stocks, to deviate from the plan. When prices are crashing, you'll feel the fear, the gut-wrenching panic that makes you want to sell everything just to stop the pain. The emotional fortress is the defense you build against your future panic self. And you build it today while you are calm and rational. You do this by creating something called an investment policy statement. This doesn't need to be a formal document. It can be a note on your phone or a single page of a notebook. On this page, you write a contract with yourself. You write down your goal. I am investing for my retirement in 35 years. You write down your strategy. I will invest $300 every month into a total stock market index fund. And then you write down your rules of engagement, the most important part. I will not sell my funds because the market is down. I will not stop my automatic investments because of scary headlines. I will not change my strategy based on short-term performance. I will only review this plan once per year on my birthday to see if I can increase my contribution. That's it. You sign it. You put it somewhere safe. And when the crash comes, and it will come, and you feel that cold knot of panic in your stomach, you take out this piece of paper. You read the words written by your smarter, calmer self. It is a lighthouse in the storm. It reminds you that this was part of the plan. The volatility, the downturns, they aren't a sign that your strategy is failing. They are the expected, normal, and necessary price of admission for the incredible long-term returns the market provides. Your fortress is this simple contract. It holds because you built it before the cannon started firing. The third and final pillar is the patience protocol. We are wired for instant gratification. We want results now. The stock market does not operate on that timeline. It operates on the timeline of farming, not of microwaves. You plant a seed, you water it, you protect it, and for a long time it looks like nothing is happening. This is the hardest part for most people. They check their accounts every day, every week, agonizing over small dips and celebrating tiny gains. This is a recipe for insanity. The patience protocol is a conscious decision to embrace boredom. Successful investing should be boring, should feel like watching paint dry. The growth of compound interest is invisible day to day. It's a quiet background process. You won't see it happen. But one day, 5, 10, 15 years from now, you will look at your account balance and you will not be able to believe the number you see. That number wasn't created by brilliant stock picks or clever market timing. It was created by time. It was created by the dividends that were reinvested, which then earned their own dividends, which were then reinvested again in a silent, explosive, exponential cascade. The patience protocol is your commitment to letting this process work. It is the discipline to plant the tree and then walk away, trusting that the seasons will do their work. So this is the system: an automated engine to ensure consistency, an emotional fortress to protect you from yourself, and a patience protocol to allow time to work its magic. Now let's turn this knowledge into action. Right now, here is your 5-step blueprint to go from beginner to investor by the end of the day. Step 1. Open the account. Go to the website of a reputable low-cost brokerage firm. Vanguard, Fidelity, or Charles Schwab are the gold standard. Choose to open a Roth IRA if you're eligible. If not, open a standard brokerage account. This will take you about 15 minutes. Step 2. Fund the account. Link your bank account and make an initial deposit. Doesn't have to be a huge amount. Even $100 is a powerful start. You are breaking the inertia. Step 3. Choose your fund and buy it. Don't get paralyzed by choice. Pick one broad market, low-cost index fund, an S&P 500 fund or a total stock market fund. Search its ticker symbol and place your first buy order. Congratulations! You are now officially an owner of the greatest wealth creation engine in the history of the world. Step 4. Activate the automation engine. Find the section for automatic investments. Set up that recurring transfer from your bank account for an amount you can afford, scheduled for the day after your next paycheck. This is the most critical step. Do not skip it. Step 5. Build your fortress. Open a notebook. Write your investment policy statement. Write down your why. I am doing this so I can retire with dignity. I am doing this for my children's future. I am doing this to buy back my own time. Then write your rules. I will not sell in a panic. I will trust the system. Once you have done these 5 things, your work is essentially done. Your only job from now on is to not mess it up. Your job is to live your life, to focus on your career, your family, your health, and let the system you built today do the heavy lifting for you month after month, year after year. We started this journey trying to demystify the world of mutual funds, but I hope you see now that this was never really about funds. It was never about expense ratios or ticker symbols. It was about taking control. It was about translating the money you earn from your precious time and labor into a form that can grow and work for you, even while you sleep. It's about building a future where your money serves you, not the other way around, where you have the freedom to make choices based on what you want, not what you need. The freedom to walk away from a job you hate. The freedom to face an unexpected expense without fear. The freedom of time. You now know more than 95% of the population about how to build long-term wealth. You have the knowledge. You have the blueprint. The only thing separating you from the future you want is that first small decisive step. Take it. Take it today. Your future self will thank you for it more than you can ever imagine.